McBain Trading, one of the, if not the largest cattle traders in the world. And Michael, so people, I think, trash and they poo the wealth effect of the, just because the Federal Reserve is raising interest rates and just because the stock market's down a little bit, that doesn't mean the economy is weak. But when I hear you say that the 1987 stock market crash, which on an intraday basis was probably the worst in history, right, definitely American history, caused cattle futures to go limit down. You think of the stock market and cattle as different markets, but even back in the day, in 1987, it was a financial futures market. The wealth effects, maybe there's something to that.
So the unwinding of the Japanese carry trade, which happened a week ago, had that same impact. That's why you see vol go through the roof, because there are guys who know they're in a trap position. They know that they got to do something about it. So they buy vol at any price out the door. Then they puke. Then the vol market explodes and they get back some of their money in the vol market. But they play these games and now they're played so fast by the algorithms that, crashes that took weeks to roll through the regular stock markets now roll through in 3 or 4 days because the algos all bounce back and forth off each other. But when you're in a trap like that, you got to sell what you can sell. And that may not be what you've got losses in because that price is plummeting. So you're selling winners from other places or you're just unloading anything that's peripheral. So like the other day, copper went down. Bitcoin went down. They've rebounded. Why? Because they weren't selling them because they didn't want them. They were selling because they needed cash. They needed cash to cover either limit positions or open positions or just safety. So a deep shock in any one market will ripple through the whole system. And then the market wants to Fed to ease to bail that out. If it was SVB or if it was Lehman or if it was, they would. But there's a threshold. It's not, the stock market's down 5%. Even if it's in one day, it's still not, the stock market's down 5%.
The stock market down 7% is not a financial crisis and nowhere close to merit a response from the Federal Reserve.
And not to say that that doesn't look at threats of volatility. The 25% sell-off in early 2022 was stocks and bonds, and it was a sell-off in bonds that was dangerous because that got into the banking system where the banks have a lot of treasuries, and it exposed the whole SVB issue and et cetera. So you just don't know. Each one is an individual event and has to be evaluated on that basis. We've had flash crashes. Nobody says Fed's got to ease for a flash crash. So this was a flash crash. It's not like the Japanese haven't been telling you for a while that they were going to do something with their interest rates. And it was not the interest rate, it was the yen. You were in a position, so if you were unhedged in the yen at 160 and the yen jumped to 145, there goes your year. There goes your job. So not that many people are unhedged, but there are some. And so when you get caught in a hole like that, it's very nasty for a short period of time. JP Morgan comes out 2 days later and says 3/4 of this is cleaned up. How do they know?
I was going to say, how do they know that?
I don't know. How do they know? Maybe they knew who was in trouble. Maybe they know the guy who was really in a bad place. But they can also tell just from market volatility. Vol came back in. We're back under 20 again, et cetera. So, and it's not just the vol indicator. It's the VVIX. It's the options on the options, that kind of stuff. So, there's a lot more signals now as to the mechanics of what's going on in the financial markets. And so it's not the old days when Paul Volcker raised rates and you didn't know.
Or you just observed it in the markets.
And that's how you observed it. Is wait a minute, the market's trading higher. Did the Fed tighten? Maybe. And you didn't know until days later. And they never admitted it. It came out in the minutes or something like that, weeks later.
I didn't know they never admitted it.
You didn't back, like in the early 70s when Wolf was doing it, you didn't know until the minutes that he had actually tightened. The desks would tell you that kind of thing, but there was no, yes, we tightened on the 23rd, not until the minutes came out.
That's pretty incredible because now not only do we know when the Federal Reserve just hiked or cuts interest rates or keeps them the same, but days before, and in some cases weeks before, it's generally well understood and well known. I can't think of an FOMC meeting at any recent years where the day before everyone in the market knew what was going to happen in terms of that particular day. There was never a surprise hike. Maybe a few days before there was going to be a 75 basis point hike instead of a 50 basis point hike. But on Tuesday night, people were not shocked Wednesday morning or Wednesday afternoon.
And that's what happened with retail sales just this week, right? You had 1.5 priced in, you got a strong retail sales number. They told you it was all going to be based on inflation and the economy. And so when the economy got too strong, bam, you take half a point out, you're back. You still think they're going to do one. Personally, I don't think they should, but it's not going to change the world if they do.
One cut in September.
One cut in September. Will it change the world if they do? Only if it's the beginning of what the market's got priced in, which is 7 or 8 over the next year and a half. But the first one's not going to matter. The second one's not going to matter because everyone expects those. If they're early or late, it doesn't really matter. The real issue is 3rd, 4th, 5th, and we're not going to know if they're going to do that for months and months at this point because it'll take so much time to get the first to it.
Michael, I remember the first time we met was my first time at Camp Kotak last year in 2023. And you said several things to me that I remember and stuck out that proved correct. Number one, you said that the global manufacturing cycle is about to bottom. And at the time, I don't think you were particularly worried about a recession. And you also cited the very low unemployment rate in Japan. Those 3 things that may initially seem unrelated, I imagine you weave them together and they became part of how you were seeing the macro picture. Can you weave that for us right now?
Yeah, so I look at the world from a global sense. I don't believe there's a U.S. economy, a European economy, a Japanese economy, a Chinese economy. I think they're all woven together and controlled by the multinationals who basically shop rules in the various constituencies to maximize their returns because that's what they're supposed to do for their shareholders. So a year ago, manufacturing was at its bottom. It's recovered since then, but it's been a very halting recovery. And it's been halting because China won't stimulate. China's in a very bad place. They're in 1931.
Really?
The private sector has lost faith in the economy. It's scared of its own government. It's scared to put money to work. And so they're not a driver. That's where the United States was in 31, and Hoover wouldn't spend the money. He lost FDR won. FDR would spend the money, did spend the money. And 32, 33, 34 was a boom period from a bust, a boom period in the United States. Will Xi Jinping spend the money? The answer appears to be no. And the answer appears to be no for 2 reasons. One, Xi Jinping's not a capitalist. He's a party head. He's more interested in stability than he is in growth. He has a shrinking economy. He knows this. He has a shrinking population. He knows this. He's got a big housing problem. He knows this. He's just fine not rocking the boat and growing 3, 4, which is miserable by Chinese historical standards. But it's still faster than almost every place else on the planet.
I've got a question. So in America, if we have a recession, generally real growth, inflation-adjusted growth, and in some cases nominal growth would be negative. But in China, GDP growth is so high. So in America, 3% growth is actually very good. Yeah. But China is used to 8% growth. Now we're at 5% growth. Would a Chinese economy that's only growing at 3% could be called in recession or no? Do you even believe the data? Does that make sense?
Yeah. So, I mean, it's not a recession because it's still growing. So, I mean, technically the words, it feels like a recession to the people there because they're used to growth being so much faster than that. Trend growth in China these days is probably around 5. Mm-hmm. So if you're 2 points below your potential, that'd be the same as if the U.S. was growing 0 and potential of 2. So it feels like a recession. And it sounds like it feels like a recession. Businesses are unhappy, consumers are unhappy, and the inflation rate's almost 0 because there's just no economic activity going on. PPI is still in deflation. The currency is weak. I mean, it is all the earmarks of a bad economy. So why won't you stimulate it? You stimulate if you want to get reelected. It's not an issue. You stimulate if there's people very upset. There's no one rioting in the streets in Japan right now.